Have you ever wondered why gold, one of the safest investments of the entire world, can't seem to get a hold onto its gains even during uncertain times? Well, that's exactly what's happening. Despite showing some early growth this week, gold prices are still struggling to gain an upward momentum, especially as the market races towards the most important economic report, which is also known as the US Non-Farm Payrolls or NFP. Don't worry if you don't understand anything at this point, we will be breaking everything down into very simple words. So for that, let's continue watching the video. As of June 6, 2025, spot gold is trading for $2,360 to $2,380 per ounce, slightly higher on the day, but still went below the multi-week peak near $2,390 that it had reached earlier this month. Gold started this week with some positive momentum due to expectations from the Federal Reserve that it might start cutting down interest rates. However, the rally lost steam midweek and now has completely flattened out, showing that the market is now in wait-and-see mode. But why? We'll be discussing that right now. One of the biggest influences on gold right now is the US Non-Farm Payrolls report. This report measures that how many new jobs were added in the previous month and is considered one of the most reliable indicators of economic strength. Economists are predicting that US added somewhere around 185,000 jobs in May, with the unemployment rate to remain at 3.9%. Well, these are decent numbers, and if the actual results matches or beats the expectations, it could weaken the case for interest rate cuts by the FED. If the job market is strong, the Federal Reserve is more likely to keep the interest rates higher for a longer period of time, which tends to reduce the gold prices. It is because gold does not pay interest. When it happens, when the gold prices are low and the interest rates are higher, the investors are more likely to pull their money out of gold and invest more into interest-bearing assets, for example, bonds. Another headwind for gold is the US dollar index, which has been trending upwards. A strong dollar makes gold more expensive for buyers, especially the ones using foreign currencies, and it ultimately reduces the international demand. As of now, the US dollar index is hovering around 104.10, and this dollar strength is another factor weighing on gold's ability to sustain gains. Meanwhile, 10-year US Treasury yields are now trading at 4.3%, which reflects the market's uncertainty about when the FED will start cutting down interest rates. When these yields remain high, they make bonds more attractive and non-yielding assets like gold less attractive. It's not just jobs and interest rates that affect gold. The entire global economic environment also plays a key role. Geopolitical risks like the ongoing conflict in Ukraine, unrest in the Middle East, and rising tensions between China and the US have pushed some investors into safe haven assets like gold. However, without clear signs of escalation, this hasn't been enough to drive prices above the $2,400 mark. Additionally, concerns about slowing global economic growth, especially in Europe and China, have made markets more cautious. But again, this caution hasn't translated into massive gold buying, at least not yet. From a technical analysis point of view, gold faces strong resistance at $2,395 to $2,400, which it hasn't been able to break through for weeks. On the downside, gold has support near $2,350, followed by stronger levels of $2,320 and $2,300. Unless the US job report shows some serious weaknesses like a sharp increase in unemployment or a sharp drop in job creation, it is very unlikely that gold will break above the $2,400 mark in very short term. If the jobs report come in better than expected, it could strengthen the US dollar further, push bond yields higher, lower expectations for rate cuts, trigger a short-term pullback in gold prices, possibly back towards $2,320. This would be a sign that the US economy is still resilient and the FED can afford to keep interest rates higher for a longer period of time, not a great recipe for gold bulls. For gold traders and investors, here's what to keep an eye on. Number 1, Friday's NFP report. Number 2, inflation data. Number 3, geopolitical news. And finally, number 4, FED speeches and meeting minutes. Until there's more clarity, expect gold to trade sideways, possibly between $2,340 to $2,390. Long-term investors should remain patient and watch the macro trends, while short-term traders may look for opportunities after the NFP results. So to conclude everything that we've discussed today so far is that gold depends heavily on high interest rates, high yields, uncertainty about FED rate cuts, as well as geopolitical risks and global economic conditions. The result? A tug-of-war between bulls and bears, and the possible outcome depends heavily on what comes in the next few economic reports. So as we wait for the NFP data, what I can tell you is the best move in gold is to stay patient. For more videos like these, stay connected to my channel and subscribe for more videos. Until next time, take care.